Mr. Subbiah, good morning. Decent numbers on net profit and net interest income, but your vehicle finance disbursements are actually down. What's happening on that front?
Yeah, so Anuj, thanks for the numbers. So as far as vehicle finance is concerned, the one thing we've said is that till we have 3 to 4 months of continuous improvement in collections, we wouldn't take an aggressive view on disbursements. So in the last quarter, is when we kind of crossed that 3 to 4 month threshold. We've had 5 months of improved collections numbers now. So now we're getting more confident to increase disbursements. But last quarter we continue to keep that cautious as a result.
Okay. Mr. Subbiah, can you just tell us what the outlook would be what were your net interest margins this quarter, and what exactly would maybe the outlook be in the coming quarters based on the context in terms of where you see cost of funds heading as well?
Yeah. Ekta, thanks. So, overall NIMs were at 8%. Now the good news, and so the NIMs overall for the year have been a bit up from where they were last year. And, we see that trend is likely to continue, though the biggest concern we have is that a lot of the banks, private sector banks, have not transmitted the reductions that the RBI has passed on. So, overall we'll be, as a result, we have to see how quickly those transmissions come. But, we have 3 or 4 factors affecting NIMs. And the two that are most in our favor right now are the fact that collections performance is improving and the cost of funds are going down. So if we combine that with an increase in disbursements as well, then all three will be in the favor of increased NIMs because we're not seeing too much of a price drop in the vehicle finance business yet.
Mr. Subbiah, so a word on your net interest margin. 8% looks quite good. Quarter on quarter, of course, there was a bit of a slip, but is that a level that you think you'll be able to maintain for next year?
Yeah, so Anuj, like I said, basically 8% is actually our net income margin, which includes both the interest margin plus fee income. And as a net income margin, I do think we will be able to sustain that over the next year. Absolutely.
Okay. What is your outlook in terms of gross NPLs, Mr. Subbiah, in the coming quarters?
Yeah. So our GNPL, if you see what happened, Ekta, is that we switched to 5 months provisioning. That's a year ahead of the RBI mandate. RBI has asked us to progressively go to 3 months over the next 3 years. But we decided it would be prudent to move to 5 month provisioning this year itself. So obviously, it's not a like-for-like comparison when we see it. When you take a like-for-like comparison, we've seen almost a 50 bips decrease in GNPA at the end of the March quarter compared to the end of the December quarter. And so that in itself is quite encouraging. But the other challenge we obviously have in the business is that we are going to see this more aggressive provisioning norm coming in every year. And as a result, some of the gains that you get on the improved performance of the portfolio are given up to the fact that you're showing higher GNPAs. But obviously it's not apples to apples. So overall the book is getting better every year.
What about your home equity book? How's that shaping up? This last quarter was up 9% in terms of disbursements.
Yes, Anuj. So the home equity we continue to be very bullish on. We continue. I mean, the business has shown about 15 to 20%, disbursement growth and even larger asset growth every year. We do see that trend continuing this year as well. So we do see fairly good growth legs for that business. And GNPAs are within control. We've never had a crystallized loss in that business. So though some accounts do move into GNPAs because of the collateral we have, usually the thing moves out of GNPA at some point in the asset's life.
Okay. Any fundraising that maybe the company would contemplate going into next fiscal?
So, Ekta, obviously we continue to raise debt on an ongoing basis. We're doing a lot of money market issuance, NCDs, we're in the market a lot, CPs, we're in the market a lot. No equity plans as of now. Our capital adequacy is currently at over 21%, so we see ourselves fairly sufficiently capitalized from an equity perspective. But definitely we do think, and we're continuously in the market for debt. So debt raising is definitely going to continue over the next quarters as we go forward.
Okay. So, Mr. Subbiah, in terms of vehicle finance, do you see any kind of turnaround, especially in the commercial vehicle space over the next few months?
Yeah. Anuj, so I've always said I'm not a great one for crystal ball gazing. But, if you look at the market, medium and heavy commercial vehicles have started picking up. And that in itself is a great trend, right? Because, we've probably seen our longest slump in M&HCV in a long while, right? It's been down for almost 3 years. So that pickup in itself is very encouraging. And we've usually seen a lag between that and what happens with light commercials and mini light commercials. So, I would suspect that if this M&HCV pickup sustains over the next 3 to 6 months, which I definitely think it should, then within a 6-month period we should see lights begin to pick up as well.